to their least favorite charity, the federal government, because Congress never asked them how they want to spend those charitable dollars. They never even send them a thank you note. And so, as a result, what we can do is we can actually move the ownership of the building before it's sold into a charitable remainder trust. This is not a charity, it is a trust set up by John and Lori, in which they are the trustees of the trust. So they would determine how those trust proceeds would be invested once the property is sold to an outside buyer for cash. They'll have $1.5 million of cash in that trust, but you see that trust has a little umbrella over the top? That's a tax-sheltered umbrella. And anything that takes place underneath that umbrella is not recognized for tax purposes. And so when they sell their $1.5 million building inside a tax-exempt trust, how much capital gains tax is recognized and payable? Real short answer, 0, because it's a tax-exempt trust selling the property, not them personally. And so now they have $1.5 million in that trust, and they set this trust up to pay themselves, my battery's getting low here, a 7% income stream for their lifetime. In effect, they could turn their fully depreciated building into a retirement plan of sorts, along with everything else that they'd have. And so for the rest of their life, they'd have an income of about $105,000 a year coming back to them from this aspect, from this charitable trust, which would be a tax-favored income, by the way. But to put the frosting on the cake, when they make the contribution of the building to the charitable remainder trust, they get a tax deduction in the current year of about $340,000. So that $340,000 charitable tax deduction shows up on Schedule A of their tax return as an itemized deduction, just as if they wrote a check to charity for $340,000, but they didn't write a check to charity for $340,000. It simply represents the present value of the calculated future remainder that's eventually going to go to charity at their calculated demise, at their calculated passing, according to a government mortality table. And so, so they avoided $280,000 of cap gains tax on the sale of the building, secured a $340,000 income tax deduction to go against a lot of their other S-corp income, which piles up and shows up on their personal tax return. So it's a very tax-effective way to sell an appreciated asset, such as a building. Real estate really works well in this case. We've also done this with C-Corp stock too, by the way, because a lot of people have very highly appreciated C-Corp stock and want to sell a piece of their business through this type of a trust. It does not work well for S-Corps. We have other strategies for S-Corps. This is just one. Then at their death, at John and Lori's death, the value of that charitable remainder trust, the remainder, goes into the family foundation. And how would the family foundation be treated? It is a charity. So it qualifies, and it'll have the funds in it that they are done using, so that the children can now work together as a way to promote family harmony for those in the business and out of the business, to have a reason to get together every year to talk about their family foundation and who they should grant some of those funds to kind of carry on one of the values that John and Lori had of being charitable. So we find this a really neat family unity tool for business owners or for non-business owners, to help pass on that value of charitable giving and provide some sense of unity within the family, even after mom and dad are gone. And so that's why I thought I'd give you that foundation idea first. Now, John and Lori might reserve a piece of the foundation to go to the University of Iowa to have an endowment or something, a scholarship named after themselves. You can do that with these family foundations. They're very, very flexible. So I just had those, well, here's my third idea. The charitable lead trust is a much less used vehicle. I think it's the most underutilized vehicle in the estate planner's toolbox. And a charitable lead trust really works well for those folks that have already gone through a sale transaction, generated a bunch of tax liability, but the year isn't over yet. And so they can actually take the cash, works real well after you've had a sale, put it into this charitable lead trust. It's the opposite of the charitable remainder trust. And so once you put the money in the lead trust, then the income stream goes to charity for a time period. Usually it's a finite time period of between 10 and 20 years. And at the end of that time period, then the corpus, or the money in the charitable trust, goes to either back to yourself, if it's a reversionary trust, or it goes down to the next generation if it's a non-reversionary trust. And this can actually be useful for S-Corp stock. If you're trying to move S-Corp stock down to the next generation, at least a portion of it. You couldn't do the whole company that way. And when you make that contribution of cash to the charitable deed trust, you get a charitable income tax deduction equal to the present value of the future income stream that's going to go to your foundation for the next number of years. So this is another way to use another charitable tool to help you achieve some of your business succession planning goals and objectives, and really continue to help fund that family foundation to help family unity and keep the money in the community rather than sending it off to Washington. So those were my 3 topics. I would mention that at our display booth we do have a 6.5-minute DVD that talks about this whole idea of heritage planning, which is holding family wealth and unity together beyond 3 generations, because statistically 90% of all family wealth and unity is blown up by the 3rd generation. We call it shirt sleeves to shirt sleeves in 3 generations. But we've got some tools and techniques that have helped the other 10%. We've learned from what they've done to hold family wealth and unity together past 3 generations. We just have a little introductory DVD. If you have an interest in that, we will not charge you for that today. And so with that, I'm going to turn the program back to Dr. Doudna.
All right, John. Thank you. Well, what we know out of this brief exercise, and if the 4 of us and the 5 of us with the good accounting firm that also works as part of this team, at the end result of working with this family over about a 12-month time period, we would be able to eliminate all estate taxes. We'd be able to accomplish all the personal objectives they've had. They'd have a more successful, well-run business. Whether they were going to transfer the business to the kids or to the key executives, they'd have a buyer for the business. And ultimately, what happens is they are relieved of a lot of stress and pressure. They have the income they want, they know their kids are taken care of, they have everything structured. So this is really a win-win story. It is the integration of all these tools. John talked about the toolbox. We have about 100 different tools that can be applied in any family circumstance. Some of them are legal, some of them are tax, some of them are insurance, some of them are managerial. And so if you want to start down this process, and by the way, even if you don't have a family member to transition a business to, the whole process, of you in front here, a successful business is the best way to have a successful transition. If you don't have a profitable and successful business, you better get it there, because you're not going to be able to transfer it to the next generation or to an outside buyer. So, end result is a very powerful thing when everything is integrated and working together. What questions would you have for anybody on the panel, or comments over what we've covered today? Late afternoon presentations are tough. Yes?
I heard something about July 7th at Okoboji. What's the information on that?
Do you know all the details? What time?
Oh, time? You really want details. I believe it's an afternoon function at Okoboji that finishes up with either dinner or golf. I can't remember which. It's on the ABI website, and it's in some of your materials as far as the schedule of upcoming ABI events. And it's going to be, I don't know if they've actually identified this precise location yet. And it's going to be a twofold. It'll be succession planning for 2.5 hours, followed by a break, and then a whole other session on business valuations, because they kind of go together. And we've had more requests for that program as well. That's been a separate program that's been produced by the Advisory Council. And so it's going to be kind of a good half day of really good, solid information with a lot more depth and a lot more time for question and answer.
And we would encourage, if you're thinking about that, and ABI will be running other programs around the state, that if you have a son or daughter in the business, or parents, whatever generation you're in, bring both generations. And if you have a key executive, bring the key executive, because all those parties are going to solve the issue. And lots of times the key executive may be a part owner of the business with the next generation. So bring multiple people. If you'd like to have a program somewhere else in the state, I think we could probably make that happen for you also. What else? Yes?
I've read a few little articles about generation skipping transfer trust.
let Bill answer that.
Yeah, you know, if you have a large enough estate and a large enough value that the kids will have, a generation skipping transfer of some sort is an ideal thing to do. What you're doing with generation skipping transfer is you're not avoiding estate tax in your current generation, you're avoiding it in the intermediate generation that is, quote, skipped. And when, you know, generation skipping sounds like a bad thing because it sounds like, oh, we're cutting out this generation. That's not really how it works. You can get income and distributions to the intermediate generation, so it doesn't cut them out. But what it does do is it leaves the property in such a way that the intermediate generation has no estate taxes on that property. So it's a very powerful intergenerational estate planning tool. And what you can do, the way the generation skipping tax is it effectively has an exclusion, just like you have the unified credit on the estate tax, and it's a similar amount. That you can leave that much property in a generation skipping format and not impose any transfer taxes on the intermediate generation. If you do it more than that amount, then you may have generation skipping tax. So the only generation skipping planning anyone does as a result is only to use up that generation skipping exemption amount, which is equal to what the unified credit exemption is.
And that's either or?
No, it's both. You can do both. So you can do.
Pass it on, and then when you die, you get to use that exemption?
Yeah, right. Well, that's not quite, that's oversimplifying. If you were to create a generation skipping trust today and transfer property to it, that will use up some of your gift tax unified credit. So let's say you do a $5 million generation skipping trust, you use up your unified credit against estate taxes. But if you elect then to have the generation skipping exemption applied to it, you can also avoid estate taxes on that $5 million or whatever it grows to, better yet, in the second generation. So for instance, if your father set up a $5 million generation skipping trust, he'd use up unified credit and estate and gift tax exemption for setting it up. He would also use up his generation skipping exemption, which would then say it doesn't have to be included in your estate when you die, and it passes to the grantor's grandchildren without taxes in the intermediate generation. So that's what it's really talking about.
So the answer to your question is there are no really good or bad tools, there are appropriate tools, and it's looking at the integration of all these things that you have a very successful outcome. So it's a very commonly used procedure.
We can talk, I can explain a little more. It's a very confusing concept to most people.
Any other questions or comments?
Why do you think these things blow up in the third generation or so? Because 90% of them are blowing up, so what's causing that? Even with good planning? Is it personal, emotional side of things?
So in the past, lots of times we talk about continuity planning. It's very easy to transfer property from one generation to another with favorable tax consequences. And so most of the failure, in my opinion, and this is borne out over 500 years all over the world, it comes down to the fact that you have different personalities in each generation. They're wired differently, like our first speaker of the day. And in the dozens and dozens of families I've worked with, the failure comes from failure to prepare the next generation with proper value systems and pass on the legacy of the philosophy of the business. And the failure then to understand there's differences between G1, G2, and G3, and actually preparing them from an interpersonal perspective of how to work effectively together. So it's not the business model that fails, it's the failure of managerial development, managerial training, and the passing on of the value system of the family or the business to the next generation. And so, you know, you went through the business cycle model this morning. The thing in my opinion, that could have been discussed, but there's, short meeting, a lot of the companies in America that fail because of value problems. They're no longer ethical. They no longer have a commitment to what the customer that they used to have. And so most of the failure has not to do with the financials of the circumstance.